First witness is Mr. Anthony J. Carfang, partner, Treasury Strategies, on behalf of the U.S. Chamber of Commerce. Welcome. You need to turn the microphone on and pull it close to you.
Thank you, Madam Chairman.
Thank you.
And Ranking Member Maloney.
And speak up.
And members of the committee. Thank you. We're pleased to present to the committee today on such an issue of such profound importance to the stability of the financial system. My name is Tony Carfang, and I'm a partner of Treasury Strategies. We are the world's leading consultancy in the area of Treasury management. For 30 years, in fact, today is our 30th anniversary, we've been working with corporate treasurers and CFOs, helping them manage their daily cash flows and growing their businesses. We also consult to the financial institutions who provide treasury and liquidity services to those corporations. We're speaking today on behalf of the U.S. Chamber of Commerce. It's 3 million members and the 3 million treasurers of those companies who will have to deal with these regulations. And what I'd like to do today is share with you the untold story of how these regulations will impact the daily management of America's businesses. As a matter of fact, there are 5 points that I'd like to make here. There are 5 chapters to this story. Number 1, American businesses are the most capital efficient in the world, and the Volcker Rule will change that. Number 2, as every treasurer knows, risk can neither be created nor destroyed, only transformed. And while the Volcker Rule may remove this risk from the banking system, it puts it right in the lap of every U.S. corporation. Number 3, the process, the rulemaking process that you were discussing earlier is so unaligned in terms of the comment periods and in terms of the implementation, that further adds to the uncertainty and increases the possibility that all except the largest banks will either scale back or reduce the number of services they offer altogether. The 4th point I'd like to make is that this is one of 4 major pieces of regulation impacting corporate treasurers, along with Basel, along with proposed additional money market fund regulations, and along with derivative regulations. All 4 of these designed to impact financial institutions, but frankly, landing right on the desk of every corporate treasurer in America. 5th point I'd like to make is there are no do-overs here. There are no do-overs. The corporate treasurers will be realigning their balance sheets, reprogramming their ERP systems to, as they change banks and change the way they manage risk and raise capital. Those are long-term changes. Now, it may take 12 to 18 months for even a mid-sized company to make these changes, and once made, they're not going to be easily reversed. I'd like to dwell on the first point of capital efficiency. Because at Treasury Strategies, we're with our corporate treasurers day in and day out, helping them manage their cash. And U.S. corporations keep cash balances of about $2 trillion here in the U.S., which is 14% of U.S. GDP. In Europe, the comparable ratio is 21%, about 50% higher. Should banks exit some of the capital raising and risk management businesses, companies will need to increase their cash buffers, and essentially we'll see the cash efficiency decline. Should that $2 billion or 14% rise to the European level of 21%, that would mean an extra $1 trillion. Corporations would have to raise and frankly sideline $1 trillion if capital efficiency decreases to European levels, which could well happen under the Volcker Rule. That $1 trillion is more than the entire TARP bailout. That $1 trillion is more than the stimulus. That $1 trillion is more than the recent Federal Reserve's quantitative easing. And to take that money out of the system and sideline it would have huge economic impacts. That can only be done through downsizing or deferring growth and expansion plans, postponing maintenance and capital investment. Not a good outcome. We encourage you to think very carefully about how all of this plays out. There are 4 major regulations designed to impact financial institutions that will impact the way corporate treasurers manage their cash day in and day out. The Volcker Rule, potential money market fund regulations, the derivative regulations, and Basel III capital requirements. All of these are untested, yet are going to hit the markets simultaneously. Ladies and gentlemen, this has not been thought through. This has not been thought through. We would encourage you to take the time necessary to think this through. And finally, the ultimate question is, when a U.S. corporate treasurer calls his or her bank in order to raise capital or manage risk, will there be anybody there to answer the phone? Thank you very much.
Thank you.
I'd be happy to answer any question.
Thank you.
Mr. Carfang, do you think that the Volcker Rule has the potential to raise the cost of capital for both large non-financial companies and small to mid-sized American businesses?
Thank you for the question, Madam Congressman. Absolutely. Because of the Volcker Rules eliminating or restricting the activities of market participants, the cost will go up. There are fewer bidders to bid down the price. But I think, an even greater concern is the crowding out of small businesses. As we continue to have concentration in the larger banks, and the Volcker Rule exacerbates that, the largest companies will still have access to, the highest credit-rated companies will still have access to capital, albeit at a higher cost. There's a real question of whether there is enough capital to avoid the crowding out of smaller businesses at any cost.
We've been working to try and increase the jobs and take down the barriers for small businesses to be able to do that. The only jobs that the dodd-frank bill seems to have increased is compliance jobs. And so, is this one of the costs that would be increased?
Well, exactly. Costs will go up in terms of, first of all,
and I hope you'll forgive me, Ms.
the cost of the services, the rates, the operating services.
Thank you. I yield back.
So let's go back. We are where we are. We had a tremendous fall. And it may be $1 trillion in costs and inefficiency to the capital market, but by my calculation, just the drop in the stock market between the summer of '08 and the end of '08 was at 6,000 points. That's $1.3 billion per point, or $7.8 trillion. That's $26,000 for every man, woman, and child in America. And so we got to deal with that. I have to deal with that. I don't think we can delay this any further. We're not going to go back to Glass-Steagall. That is the bright line test. So, Mr. Carfang, do you disagree with what I've said, or don't we have to have some restrictions in there?
I absolutely agree that unbridled risk-taking, should not be supported by taxpayers, by deposit insurance. The issue is the gray area around, and the lack of clarity around the regulations, and the lack of a precise definition of proprietary trading. Much of what could be falling into this gray area has become standard risk-taking practices that every company uses, even individuals use. And without that lack of clarity, the fear on the part of corporate treasurers is banks will err on the side of, conservatism and withdraw from businesses, making medium-sized and small businesses totally without access to capital raising and risk management tools. We absolutely agree that
So my question to you then is, I'm not sure it's the rulemaking as it is getting rid of, from your position, getting rid of Section 619.
Yeah, we already have a robust system of capital requirements that Basel II is making even stronger with the additional capital requirements for systemically important institutions. In addition to that, regulators have substantial latitude in terms of the risk weighting of assets on bank balance sheets, and I think that is where you manage the problem, not simply coming up with hundreds of pages of prescriptions on how 3 million U.S. treasurers should do their job every day. That's not doable.
Thank you.
In the first panel, I know some of you were here.
Governor Torello said that if there's a kind of an astounding comment, if there's a better idea out there, we're open to it. Does anybody have a better idea? I've heard some specifics, but does anybody have a better idea of approach to this? That's one question. And part of that question is, I've heard some of you say that you don't think it's possible to make the distinction clearly enough, I think, Mr. Elliott, between market making and proprietary trading. And so I guess I'd be interested in what everybody thought about that. So those two, start off with those two quick questions, and I only have 5 minutes.
Well,
Please.
Sir, you know, it's our sense that among the better ideas are many of the regulations that are already in place, as I mentioned earlier, on capital requirements and on risk weightings. There are 4 major pieces of regulation that are impacting corporate treasurers, none of which have been tested. The capital requirements of Basel II, the Volcker Rule, money fund regulations, and derivatives regulations. We think a better idea is to not do all 4 of them at the same time.
Okay.